Okay, so the economy is on a tear. Consumer confidence is soaring. So why are some experts saying it's time to get out of the markets? Jonathan Hoenig, hedge fund manager at capitalistpig.com. Okay, so look, there's this big write-up in the Wall Street Journal this morning, and it says, it's time to sell because things are so good, it's time to sell. And I'm not going to get all the wonky research and details that this author gave, but what do you make of this? That with GDP over 4% and consumer confidence at an 18-year high, that means get out. What do you say?
Yeah, well, I mean, it seems kind of backward. As you said, Cheryl, look, the economy is soaring. We know that. Jobs are doing quite well. The ISM is doing well. GDP, all these indicators for the economy are terribly positive. The problem is, Cheryl, is that those are lagging indicators. That's past news. The market is a forward-looking indicator. And just think now, we're 9 years into this bull market. Back when the bull market started, all of those indicators were really in the toilet. 9 years ago, you had to convince people to buy stocks. There really was no clear indicator. So that's the real issue here, Cheryl, is that positive confidence tends to be negatively correlated with stock prices. And, we've only seen this level of confidence two other times in market history. One was in 1960 before a big down period in the 70s. The other was in the late 1990s.
But
you remember what happened
I got to push back, though, and I know that the data shows that. But, this is a different economy. This is not the dot-com bubble of 2000. This economy, this market is based on actual American productivity. It is based on tax cuts. I mean, we have a regulatory environment now that's never been more favorable for businesses and a corporate tax rate that is now cut in half. I mean, don't you think that that's a different story? And especially with all the tech names we're talking about right now, we've never seen this type of economy before.
Yeah, tremendously positive. Everything you said is absolutely accurate, Cheryl, except for one thing, that when you alluded to that, it's different this time. We know it's never different. And companies like Facebook, like Amazon, terrific companies, as you said, in many cases, good numbers, but a lot of these stocks are up 100% in just the last 12 months. A pullback is due.
Let me switch to trade really quick here, because we were watching futures this morning. We actually took kind of a hit in the futures markets, S&P and the Dow in particular, over this news that the Chinese are going to go to the WTO about the tariffs, the U.S. imposed tariffs. We're talking $267 billion. And look, we're down 90 right now, Jonathan. $267 billion in addition to another $200 billion that's already proposed. That comes to $505 billion in tariffs, Jonathan. When does the market react to that?
Well, how can the market do anything other than just how can you invest, Cheryl, for the long term, really not knowing what the trade situation is going to be 6 months, even a year out? So, once again, we're seeing this pattern of investors kind of throwing up their hands and saying, let's wait and see until all this, we were told it was going to be threats to begin with. These were just negotiating tactics. But as you said, this trade tariffs have turned into a real trade war. And I think that's one of the reasons you saw, exactly as you said, as this new tariff trade a skirmish broke, you saw the market drop about 100 points.
And we saw the Chinese markets close in the red as well. So I think that's kind of indicative of what's going on. Jonathan Hoenig, thank you, sir. It's great to have you on this morning, as always. Good to see you.